Hello fellows, welcome to my channel. This channel is created for educational purposes only, dedicated to people who want to learn how to trade. Either you want to trade stocks, crypto, commodities or Forex. You will find high quality educational material. Either you are a beginner, advanced or an intermediate trader. For viewers that want to see more action and how we apply the theory in real trades, you can visit our live channel. Here we are trading our live account and applying the theory, proving that it can be done, while all trading profits go to our subs. However, as a beginner, I do not recommend starting with any real money. Trading is very risky and challenging. However, a risk comes always with a reward. You will find 50 videos to understand the theory, 12 sections. Each section is a playlist consisting of several videos. I do not recommend skipping chapters and trying to take classes from the beginning. We are using verified sources to provide the most accurate information. Remember, this is an educational channel and you will always trade with demos to avoid the risk. Make profits in the market is not the easy passive income you have in mind. The entire material is the same as you will find in most trading courses. The material is totally free and you don't have to pay any guru to learn generic information or waste thousands of dollars. So if you want to support us, subscribe, like and leave a comment for the YouTube algorithm. And you can post your progress in our Facebook page. Thank you very much and trade safe. As we proceed further and deeper into our analysis, we have the currency cross pairs. The chaotic nature of binary options can be simplified by using currency crosses. But let's see what are currency crosses. As winners write history at the end of Second World War, most currencies were quoted against the US dollar. The US economy was the strongest post-war and its currency was fixed to gold. Historically, an individual who wished to exchange a sum of money into a different currency would be required first to convert that money into US dollars and then convert it into the desired currency. In order to ensure a fair settlement, currencies were filtered in value measured to USD. Although the USD dollar still acts as the world reserve currency, the rise of the Forex market has made cross-currency transactions and cross-currency pairs common. So what are currency crosses? In simple words, currency pairs that do not involve the US dollar. In the Forex market, currency pairs are typically quoted in relation to the USD, such as Euro USD, GBP USD, and so on. However, currency crosses are formed by pairing two major currencies that are traded directly against each other without involving the USD. For example, Euro GBP is a currency cross that represents the exchange rate between the euro and the British pound. In this case, the value of the euro is expressed in terms of British pound. Similarly, GBP/GPY represents the exchange rate between the British pound and the Japanese yen. We will give a practical example of this pair due to its historical value. The GBP/GPY cross was invented to help individuals in UK and Japan who wanted to convert their money directly without having to first convert it into US dollars. In this example, we have two major pairs, the GBP/USD and the USD/GPY. The common currency between them is the USD. Now let's remove the USD from the equation. Let's give an example. The USD GBP FX rate is 1.28. For every 1 GBP, we get 1.28 US dollars. So to get 1 USD, we need 0.78 GBP. The USD GPY pair is 141. For every 141 GPY, we get 1 USD. In order to find the GBP GPY, we divide 141 with 0.78. So 1 GBP is equal to 181 GPY. The same is for every currency cross. Over 80% of the transactions in the Forex market involve the US dollar. The US dollar is the reserve currency of the world. Most agricultural and commodities such as oil are priced in US dollars. If a country needs to purchase oil or other agricultural goods, it first has to change its currency into US dollar before being able to buy the goods. Many countries keep a reserve of US dollars on hand. Countries such as China, Japan and Australia are examples of heavy importers of oil, and as a result they keep huge reserves of US dollars in their central banks. China has over 3.12 trillion US dollars and Switzerland holds over 1 trillion. So the basic question is the US dollar weak or strong today? we have analyzed what are the major pairs: GBP/USD, EUR/USD, USD/CHF, USD/JPY, and we will do another episode on commodity pairs such as Australian, Canadian, and New Zealand. So the most important question is how well will the USD perform? In the stock market, traders have multiple companies to choose from and multiple industries: manufacturing, energy, retail, and so on. By using currency crosses, you have the same, more trading opportunities. At this point in this series, you will see only major currency trades. Of course, this is my personal trading opinion, and it's up to you. There is no definitive list of currency crosses to avoid in Forex. Some currency crosses may be more challenging or carry higher risk than others. The suitability of a particular currency cross depends on various factors, including liquidity, volatility, economic stability, and geopolitical risks. Here are a few points to consider when evaluating currency crosses. Here is the important list. Some exotic currency crosses might involve currencies of emerging markets or smaller economies. These crosses can have limited liquidity, higher spreads, and increased volatility, making them more challenging for traders, especially those with less experience. Low liquidity. Currency crosses with low trading volume can be illiquid, meaning there may be wider bid-ask spreads and limited trading of higher profit opportunities. Higher spreads means less profits for us and wider stop losses. These crosses can make it difficult to execute trades at desired prices and increase the risk of slippage. Currency crosses with limited information. It is important to have access to reliable and up-to-date information about the economies and markets of the countries involved in a currency cross. Trading crosses with limited information can make it challenging to make informed trading decisions. Geopolitical and economic risks. Currency crosses involving countries with unstable political or economic situations may be subject to increased volatility and uncertainty. Sudden policy changes, political events, or economic crises can significantly impact exchange rates. Some currency crosses exhibit high correlation with each other, meaning they tend to move in similar direction. We will cover currency correlation in an extensive episode. Trading high correlated crosses may result in limited diversification and increase the risk of overexposure to a particular currency or region. Especially for new traders, it's not recommended to trade currency crosses that do not involve more stable economies. When trading fundamentals with currency crosses, it's important to understand that fundamental analysis involves analyzing economic data, news events, and other macroeconomic factors that can influence currency values. We have done another episode for fundamental analysis, and you can find all the description below. Trading fundamentals with currency crosses requires a deep understanding of economic factors and careful analysis. It's important to continually educate yourself and stay up to date on market developments and adapt your trading strategies based on new information. Let's give an example on how complicated can the market be and how the currency crosses can save the day. Let's say you speculate that the oil prices are getting higher. In this case, a commodity currency like the Canadian is most likely to become stronger. But as oil prices are getting higher, what most traders would do is going short to the USD CAD. And imagine in a period of strong inflation, then the rates will be increased significantly. And as the major currency reserve is the USD, there is also a reverse relationship between USD and oil prices. Now the currency crosses will save the day. Now our fellow trader knows that the oil prices will go higher, or at least he speculates. He won't trade the USD CAD pair directly. But is there any other pair that comes in your mind? I'm waiting in the comments. Currency crosses will provide a solid solution in those situations. Synthetic pairs are for institutional traders and money movers that cannot find so much liquidity in a particular pair. But again, if you are still interested in watching this part, be my guest. A synthetic currency pair involves creating a virtual currency pair by combining two separate currency pairs. This allows traders to speculate of the exchange rate between two currencies without a direct currency pair available in the market. Again, let's give an example. Let's create a pair. If you want to create the exchange rate between the euro and the Australian dollar, there is no direct euro-Australian dollar pair available. You can create a synthetic pair by combining the euro USD and the Australian USD. Again, if you keep watching this, I'm really glad. At this point, we need to analyze the historical data and the correlation between the two currency pairs. The correlation helps determine how closely the two pairs move together or in opposite direction. A strong positive correlation means the two currency pairs tend to move in the same direction, while a strong negative correlation indicates they move in opposite direction. Again, we will cover this topic in another episode. To calculate a synthetic pair, you need to follow the same steps with the JPY example we gave in the first part. It's important to note that trading synthetic currency pairs involves additional complexity and may carry higher risk due to the potential of increased spreads, slippage, lower liquidity, and again our suggestion is to avoid them. But let's see some pros and cons of trading currency crosses. Wide range of trade. By trading cross currency, a trader has the opportunity to make wide range of trades. Currency crosses will generate more trades. You won't be affected so much by the huge volatility of the USD, and especially when big news is about to come out. In theory, cross currency pairs are smoother in trends than major, especially due to big events to the USD. You can have benefits from interest rates that we will see in carry trading episode. Cons: big spreads, more commissions and overnight fees, less profits for us, less profits for day trading, high insecure markets that are easily being affected by local political and social events. By excluding the USD from the equation makes your trading more unstable. You start to trade riskier and riskier pairs. As a result, you will overtrade. That's it. Thank you for watching. Go back, repeat the chapters you are not sure, and you will find your name in the Arintra supporters. Help us to launch it. You will find more info in the pinned comment. Trade safe. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes and comments for the YouTube algorithm. Help us to make more content and trade safe.